Hello, in this lecture we're going to go over a net present value calculation. At the end of this, we will be able to explain how the net present value calculation is used and calculate the net present value in an example. So in order to do this, we're going to think about the net present value in terms of a long-term investment, in this case the investment in equipment. This is going to be a standard type of problem for managerial accounting when we're looking at the longer-term investments. We usually want to have more of a systematic approach to thinking about the longer term investments because they will affect a significant time period into the future. And when we think about that type of analysis, part of the analysis should be the time value of money. So we're going to try to take into account the time value of money, the time value of money being the idea that money at a later time period is worth less than the money today for a couple different reasons. One, obviously, just the measuring tool of money will probably devalue due to inflation at between 1% and 3% or so. And the other being that there's opportunity costs with money. If we had the money today, we could be using the money and getting value of the money through that time period. And therefore, we need to think of what that opportunity cost would be, meaning what would we do, what could we invest in that in order to generate revenue? And of course, when we think about businesses, that's the goal. The goal is to generate revenue. So if we had the money today, the idea would be, well, what type of return could we get with the money if we had it today? And then we can kind of set a discount rate and think of how we can present value money into the future based on that discount rate. So that's what the idea of how we're gonna come up with this problem. So we're going to say that we're going to invest in a equipment for 100,000 piece of equipment. It's going to have a useful life in terms of depreciation of 5 years. It's going to have yearly income resulting from this for 72,500, and we have a tax rate of 40% for this problem. Now, sometimes when we think about these type of investments, you might be asking, how is it that we know that we're going to get 72,500 from the investment in a piece of equipment? Because it's, when we put the equipment on there, it's going to be an expense. When we put the equipment on the books, of course, buying the equipment, we have to do some type of calculation. We're going to say we're going to spend this money on the equipment. We're going to increase the production level in order to do that. And we're going to try to figure out how much revenue we're going to get yearly based on that increase in production level. And that's the number that we're going to use in order to figure out, well, is it a good idea to buy the equipment or not? Now, we're going to look at the difference between depreciating this equipment between a straight line method and a maker's method and see what the difference would be in terms of the net present value calculation. This is a good example because the difference between these two are just timing differences on the expense side of things, and the timing difference will affect the taxes. So just a recap of what the straight line method and the maker's method is that a straight line depreciation just means that we're going to depreciate evenly over the time period, in this case, the 5-year useful life. One little twist when we think about taxes is that we always think that we buy something in the middle of the year. We call that the mid-year convention. So we actually have 6 years we're talking about. We got the first year that we assume that we bought it in the middle of the year for taxes. And then we have the straight line method here. And then the last year, of course, we have to have that half of a year as well. So if we took the 100,000 divided by the 5 years, we would have 20,000 a year. But the first year and the last year, we're assuming that we bought it in the middle of the year, and that's why we have that half-year convention. The maker's method over here is an accelerated method. That's the point, that we're going to be depreciating more in year 1 than we will be in the year 6 in this case. And that difference, that's going to be the timing difference. Notice that the total is the 100,000 in each case, but we're going to depreciate more in the beginning years and less in the later years when we use an accelerated method. Now, the accelerated method of makers is not quite the same as double declining balance, but it's kind of the same concept. So just remember the idea of this double declining balance, or an accelerated method in this case, is we could take this calculation of, I'm just going to take 1 divided by the useful life, and that will give us the 20%. That would be the straight line rate. So for example, if we took the 100,000 times 0.2, that gives us the 20,000 straight line depreciation. And then if we just double that, of course, if we took the 20,000 times 2, then that will give us the double declining rate. So if we were to try to figure out just a couple of these numbers, it's not exactly the same as double declining, but it's similar. So if we took the 100,000 times 0.4, 40%, we would have 40,000 in year 1, except we still have that mid-year convention that we bought it like in the middle of the year. So we're going to divide that by 2, and that's where that 20,000 is. And then in year 2, we would take the book value, so that would be the 100,000 minus the 20,000 that we depreciated in year 1. We have a book value of 80, and multiply that times the 40%, and that's how we can come up with this number. But the idea that these are givens here, the idea being that this is going to add up to the same 100,000, bringing the book value down to 0 over that time period, over the 6 years, and this will do the same thing, but there's a difference in timing between the two. So now we're going to calculate the straight line. We're going to look at the income before depreciation. We're going to look at the straight line depreciation per year, years 1 through 6. We'll calculate the taxable income. We'll calculate the income tax then, and then we'll calculate the net income and the net cash flows. Now, note what we're really looking for here is the net cash flows. What we want to see is the net cash flows, and then we're going to take that net cash flows and present value it. What we are not concerned with, which is often confusing when people first look at this, is that we're not looking at the net income from the project, meaning we're not looking at the income we're generating minus the expenses, which would include depreciation. What we really want is the cash flows, because depreciation is not a cash transaction. We're looking for the cash flows. So the only reason this depreciation is a factor here in the differences is because of taxes. Taxes always distorts things. So the thing that's going to be a problem here, it's not going to be the depreciation that's going to affect the net present value between the two calculations if it weren't for taxes. The difference in the depreciation is going to affect the timing of when we pay taxes. That's the cash flow that will then affect whether we should use, straight line method or double declining balance, or what the difference would be between the two. Okay, so we're going to take this, we're going to say the income before depreciation is just a given. We're going to have the 72,500. That's going to be a given. So we have that all the way down. 72,500 will be the income. It's going to be an even income before we take into account the taxes. And that's going to be the income that we're assuming is going to be increased in the income from the purchase of the equipment. And then we're going to say that the straight line depreciation is 10,000. So we have 10,000 here, and we're just pulling this number in year 1. From the straight line area here, and we're just pulling these numbers over. So that's going to be the straight line depreciation for years 1 through 6. And then if we subtract that out, we got the taxable income. So this is the income before depreciation minus the depreciation for each year, gives us the taxable depreciation. The 72.5 minus the 20,000 gives us the 52.5, 72.5 minus the 20,000, 52.5, 72.5 minus the 20,000 gives us the 52.5, and so on. And then we're going to calculate the income tax. Income tax is going to be calculated at that 40% rate. So the income tax then would be calculated at the 62.5 times 0.4, and that's going to give us that 25,000. So we're going to do that all the way down, of course. So we're going to take the 52.5 times the 0.4, 21,000, 21,000, 21,000, 21, because it's straight line, and then back to the 25 because of that mid-year convention. And then we're going to calculate net income. So remember, what we really want is the net cash flow, but I'm going to calculate just in net income just to complete our table here. So we've got the taxable income minus the income taxes. So now we got the taxable income minus the income taxes gives us the net income. So here's the net income. We're taking this minus this, and we're getting the net income all the way down. What we really want is going to be the net cash flow. That's what we're going to take the present value of. And so remember, this is going to be the cash flow before taxes, and then we're going to subtract out the taxes. So we've got the 72.5 minus the 25,000 in year 1. So we're going to say, okay, it's the 72.5 minus the taxes related to this of 25,000, and that's going to be the 47.5. So we got the 47.5. We're going to do the same thing here. 72.5 minus the taxes of the 21 gives us the 51.5, and we could do that all the way down here like so. Notice what we're not taking into account. We're not taking into account the depreciation. We're not saying it's the 72,500 minus the depreciation expense and the taxes. We're taking the 72,000, assuming it's a cash flow, minus just the income taxes, because that's going to be a cash flow item, and we're getting these numbers here. So if we add those up, then we've got the 301,000. That's going to be the net cash flows in just dollars, not in terms of present value. And the problem with this, of course, is that the dollars in year 6, this 47.5, is not the same in value as the dollars in year 1.